Let me ask you something. What if I told you that a 3-digit number you probably checked last month is quietly costing you more money than almost any other single thing in your financial life? Not your rent. Not your car. Not your groceries. A number. And here is the part that really gets me. Most Americans have no idea what that number is actually doing to them. They check it, they see it as not great, they feel a little bad about it, and then they close the app and move on. But that number does not close the app. It keeps working. Every single day. Every time you apply for anything. Every time you borrow anything. Every time you try to rent an apartment, or buy a car, or even get a job in some states. It is working for you or it is working against you. There is no in between. And if it is working against you right now, the cost is not small. The cost is not a few $100s a year. Over the course of your financial life, a poor credit score can cost you somewhere between $50,000 and $200,000 in extra interest payments, higher insurance premiums, worse loan terms, and missed opportunities. That is real money. That is life-changing money. That is money that should be yours. And the reason most people never fix it is not because fixing it is hard. It is because nobody ever explained how it actually works in plain English. So that is what we are doing today. From the beginning. No jargon. No confusion. Just the honest truth about your credit score and exactly what to do about it. Stay with me. Because by the end of this video you are going to understand your credit score better than most Americans ever will. Let us start with the basics because most people think they understand this and most people are slightly wrong. Your credit score is a 3-digit number between 300 and 850. The higher the number the better. But here is what most people do not realize. That number is not a measure of how good you are with money. It is not a measure of how hard you work, or how responsible you are or how much you earn. It is purely a measure of how predictably you pay back borrowed money. That is it. Nothing else. You could be the most financially disciplined person alive. You could save 30% of your income. You could have $20,000 sitting in your savings account right now. But if you have never borrowed money and paid it back, your credit score will still be low or non-existent. Because savings do not count. Only borrowing history counts. And conversely, someone who has borrowed a lot and always paid it back on time can have an excellent score even if they spend every dollar they make. The system is not measuring your financial wisdom. It is measuring your borrowing behavior. Those are very different things. Understanding this is the first step because once you know what the system is actually measuring, you can play it intentionally instead of just reacting to it. Here is how your credit score is calculated. 5 factors. Every single one of them matters. The first factor is payment history. This is the biggest one. It makes up about 35% of your total score. Every time you make a payment on time, that is a positive mark on your record. Every time you miss a payment or pay late, that is a negative mark. And negative marks do not disappear quickly. A single missed payment, one time, can stay on your credit report for 7 years and keep costing you money every single day it is there. 7 years? One missed payment. Think about that. The second factor is your credit utilization. This makes up about 30% of your score. Credit utilization is the percentage of your available credit that you are currently using. If you have a credit card with a $5,000 limit, and you have $2,500 charged on it, your utilization is 50%. Most experts say to keep it below 30%. The people with the highest credit scores typically keep it below 10%. This one is important because it is also one of the fastest things you can change. Pay down a balance and your utilization drops immediately. Your score can go up within 30 days. The third factor is the length of your credit history. About 15% of your score. The longer you have had credit accounts open and in good standing, the better. This is why closing old credit cards is usually a mistake even if you do not use them anymore. That old account is adding to your average age of credit history. The fourth factor is credit mix. About 10% of your score. Having different types of credit, a credit card, a car loan, a student loan, A mortgage shows lenders you can handle multiple types of borrowing. You do not need all of these, but having at least 2 or 3 different types helps. The fifth factor is new credit inquiries. About 10% of your score. Every time you apply for new credit, and the lender does a hard pull on your report, it temporarily lowers your score a little. Applying for 5 credit cards in a month looks desperate to lenders. Space it out. This is the part most people skip over. And it is the most important part. Let me show you the real math. 2 people need a $300,000 mortgage to buy a home. Person A has a credit score of 760. They qualify for an interest rate of around 6.5%. Their monthly payment is roughly $1,896. Over 30 years they pay about $382,000 in interest. Person B has a credit score of 620. They qualify for an interest rate of around 8.5%. Their monthly payment is roughly $2,306. Over 30 years they pay about $530,000 in interest. Same loan. Same house. Same 30 years. Person A paid $382,000 in interest. Person B paid $530,000 in interest. The difference is roughly $147,000. $147,000. Because of a credit score. And that is just one loan. Now add the car loan they got at a higher rate. The credit cards with higher interest because their score was not great. The apartment that required a larger security deposit. The insurance premiums that were higher because in most states your credit score affects your car and home insurance rates. Add all of that up over a lifetime and you start to understand why I said poor credit costs people between $50,000 and $200,000. This is not a small problem. This is one of the most expensive silent problems in American personal finance. Here is where most people are unknowingly doing damage. The first mistake is carrying a high balance on your credit cards. Not missing payments. Just carrying a balance. Remember, utilization makes up 30% of your score. If your cards are maxed out, or even just above 30% utilization, your score is taking a hit every single month. Even if you pay on time every month. The solution is not complicated. Pay down the balance. Even partially. Even just getting from 80% utilization to 50% will move your score. The second mistake is closing old accounts. People pay off an old credit card and immediately close it because it feels good to be done with it. I completely understand that feeling. But closing it removes that available credit from your utilization calculation and shortens your average credit history. Both of those things lower your score. Leave it open. Cut up the physical card if you want. But leave the account open. The third mistake is applying for too much credit at once. Every hard inquiry drops your score a few points. 5 hard inquiries in a short period tells lenders you are in financial trouble and desperately seeking credit. Space out any applications by at least 6 months. The fourth mistake is not checking your credit report for errors. This one is huge and most people never do it. About 1 in 5 Americans has an error on their credit report. An error that is incorrectly lowering their score. A payment marked late that was actually on time. An account that belongs to someone else with a similar name. A debt that was paid off but still shows as outstanding. You can get your free credit report at annualcreditreport.com. Check all 3 bureaus. Equifax, Experian, TransUnion. If you find an error you can dispute it, and have it removed. And when a negative item is removed your score goes up. People regularly report raising their score by 20 to 50 points just by successfully disputing errors they never even knew were there. Here is the fastest path from a bad score to a good one. And when I say fast I mean 6 to 12 months of consistent action. Not overnight. Not a credit repair company that charges you $500. Just specific actions done consistently. Step 1. Check your credit report for errors right now. Not next week. Right now after this video. Go to annualcreditreport.com and pull all 3 reports. Look for anything that looks wrong. Dispute anything that is incorrect. This is free and it can move your score immediately. Step 2. Get your utilization under 30%. If you have credit card debt, make paying it down your financial priority number one. Even before investing in most cases. Because the guaranteed return of eliminating high-interest debt beats almost any investment. Focus on whichever card has the highest utilization first. Get it below 30%. Then below 10% if possible. If you literally cannot pay down the balance right now, call your credit card company and ask for a credit limit increase. Ask if they will do a soft pull instead of a hard pull so your score does not temporarily dip. Many companies will accommodate this. Same balance, higher limit, lower utilization percentage. Step 3. Set up autopay for every single bill. Payment history is 35% of your score. One missed payment can hurt you for 7 years. Autopay removes the human error from the equation. Set it up for the minimum payment on every account. Then pay extra manually when you can. Step 4. Become an authorized user on someone else's account. If you have a family member or close friend with excellent credit, ask them to add you as an authorized user on their oldest credit card. You do not need to actually use the card. Just being added gives you the benefit of their long positive credit history. One important thing here. Make sure that person actually has excellent credit and always pays on time. If they miss a payment, it can hurt your score too. Only do this with someone you completely trust. This is completely legal, and it can move your score significantly within 30 to 60 days. Step 5. Get a secured credit card if you have no credit history. A secured card requires a cash deposit that becomes your credit limit. You use it for small purchases. You pay it off in full every month. After 6 to 12 months of this, you will have established a positive payment history, and your score will start to build. Here is what changes when your score crosses 700 and then 750. Below 670 you are in subprime territory. Higher rates on everything. Some apartments will not rent to you. Some employers, particularly in financial services, government, and security clearance positions, will check your credit as part of the hiring process. You pay more for insurance in most states. From 670 to 739 you are in the good range. Better rates. More options. But still not the best deals. From 740 to 799 you are in very good territory. You qualify for the best rates on most loans. Landlords and employers see you as low risk. Above 800 you are in exceptional territory. You get the absolute best rates on everything. Banks compete for your business. You have leverage in negotiations because you are the borrower everyone wants. The difference between a 620 score and a 760 score over your lifetime is not just the $147,000 mortgage example we talked about earlier. It is also the car loan you got at 4% instead of 12%. The insurance premiums that are hundreds of dollars a year lower. The apartment that did not require 3 months security deposit. The job you got because your credit check came back clean. A good credit score does not just save you money on interest. It opens doors. It gives you options. It quietly makes your entire financial life easier in dozens of ways you never even notice because the problem is gone. I want to be honest with you about timing because there is a lot of misinformation out there. If you have errors on your report and get them removed, you can see improvement within 30 to 60 days. If you pay down high utilization, you can see improvement within 30 days. If you set up autopay and make on-time payments consistently, you will see gradual improvement every 3 to 6 months. If you have serious negative items like collections, charge-offs, or late payments, those take longer. They do not disappear overnight. But their impact decreases over time. A late payment from 4 years ago hurts you less than a late payment from 6 months ago, even if both are on your report. The realistic timeline for someone starting with a poor score in the 500s and doing everything right is 12 to 24 months to get into the good range. That sounds slow. But those 12 to 24 months are going to pass anyway. The question is just whether your score goes up during them or stays the same. Your credit score is not a punishment. It is not a judgment of who you are. It is a system. And like any system, once you understand the rules, You can work with them instead of against them. The 5 things that build your score: payment history, utilization, length of history, credit mix, new inquiries. You now understand all 5 better than most Americans ever will. The mistakes people make that quietly destroy their scores: carrying high balances, closing old accounts, applying for too much credit, never checking for errors. You now know to avoid all of them. The steps to actually fix it: check for errors, get utilization down, set up autopay, become an authorized user, get a secured card if needed. You have a real plan. The cost of not fixing it is real. The benefit of fixing it is real. And now you have no reason not to start today. If you want to understand why being in a poor financial position costs you more money in almost every area of your life, not just credit, that video is right here. Watch that next. Everything connects.